Hello. Hello everyone. This is the fifth lecture that we are studying economics. Today's lecture we will study what is project financing or what is financing. So let's start this. So financing. Before starting financing directly, let's move on to some basic things related to financing. One of them is debt. That is acquisition of funds by borrowing, corporate or project loans, leasing or agreement. That means we have to take some loan or something kind of thing from some banks or some financial organization. That is called debt. The other thing is equity. Equity is selling shares for raising capital. Suppose there are some companies, they are launching their initial public offers, or we can say IPOs, or they are selling some part of their some part of their uh, company in a public market. That's called equity. Or they are guaranteeing something that we will assuring you that something that we will do some this kind of work, or we will deliver this project. So through this they sign some bonds or some grants or guarantees. In that way, a financing of a major independent capital investment that the sponsoring company has segregated from its assets and general purpose obligation. That is the definition of financing. That is by the Vanant, that is Harvard Business Review, published in the Harvard Business Review 1980. What is it? A financing of a major independent capital investment that the sponsoring company has segregated from its asset and general purpose obligation. That is the general definition of financing. Now, financing with resource, corporate financing or balance sheet financing with recourses, that is corporate financing or balance sheet financing. Now, non-recourse financing will be lenders only have recourse to cash flows of projects and the project's asset in the event of a project failure. In that way, the financing will be done for a whole company, and in this type of financing will be done for only for a single project only. That will be project based. Now, some what is the risk return profile? If we are getting some loan, then the financial company that from which we are getting some loan, and also whatever we are getting some debt or equity, then there is a risk return profile. How much risk is there and how much return is there? Suppose the project doesn't work, then uh, we have to manage our losses, and to minimize the losses and maximize the returns, this risk return profile needs to be understood. So here in the x-axis is the return and y-axis is the risk. We see this is the risk return profile, typical risk return profile. If our calculation, our values falling in this region, then we should invest, or if we are giving any kind of loan, we should invest in this region. And if we are the calculation are being made in this region, then we should not invest. So this is how risk return profile tells us what should we do. Now let's take an example. What is the let's take an methodology into account. What is the methodology of cost analysis? Here, cost analysis is done with the various factors. Here you can see the some kind of graph or some good tree diagram, typical tree diagram. It's starting from the annual plant output and feed in tariff. That will help us to get an annual revenue. The annual revenue will tell us the EBITDA margins and the annual working capital of a company. Here, in an annual working capital, the annual operation and maintenance expenses are added, and the whole thing will goes to the free cash flow to the firm. Also, this annual O&M expenses will go to the EBITDA margins, and that EBITDA will help us to calculate the EBTs or taxes. The MAT rates also associated with the taxes, and EBT will annual depreciation will also help in that EBT, where the depreciation rate we can calculate the depreciation. These things we have already studied. This is the typical methodology of doing a cost analysis. A salvage value will tell us the free cash flows to the firm, and taxes EBTs will tell us about the net profit. While after calculating the capital cost will be associated with the free cash flows and the annual depreciation, and it's also be associated with the total debt. From the total debt, the debt equity ratio will help us, and finally to the total debt will be equal to the will be associated with the net annual repayment to the total debt, and finally we can calculate the IRR, that is the initial rate of return. That is the internal rate of return. So this is how the methodology of cost analysis works. I will take an example, then you can understand it in a better way. So let's move on to the financial thing. Let's start with the financial basics. What is risk and returns? Whenever we are starting a project or a project, there are few things. One is returns, sorry, risk, and there is a return. How much loss we can make, how much profit we can get. So in that way, we can create a project's risk return profile. In the risk, there are two kinds of major risk. One is the credit risk, and that is the commercial risk. Credit risk will be associated with the sponsor credit worthiness, and the commercial risk will be the resource, wind speed, technology proven or not, whatever technology that we are using, or environmental landscape, bird life, or NIMB, BBY, revenues, like customer will be interested or not, operational maintenance requirements. So these are the things that will be associated with the commercial risk. Now let's move on to the returns part. On the other hand, returns will be majorly can be three. We can divide in the three broad ways. One is the project cost. How much out means the suppose we're working on a project, and what is the final cost after completion of the project. So that will be our return. Project cost and how much in, and that the means of financing, cost of capital. So these things will be associated with the risk returns in the any financial analysis. Now, risk. Risk. There are few things that is associated with the risk. One is the like a few of them are credit risk, construction and development risk, operating or commercial risk, political risk, financial risk, regulatory or some local risk, legal risk like any law and order risk. We can say law and order risk, environmental risk or force majeure. So these are the things like if you are starting a project, you should consider these things. Should take into consideration before starting any project. Yeah, this thing is force majeure that is beyond our control. So suppose that corona thing that happened in any project, that is not in our control. So that things will come under the like natural calamity or something like natural disasters that we can't measure. We can't prejudge the things that will come under the force majeure. Now let's see this table. This table shows a corporate and project financing. These are the dimension for the comparison. The dimension like the financial vehicle here. Corporate finance will be multi-purpose organization and the project finance will be the single purpose entity. Type of capital will be permanent in the corporate finance and the in the project finance will be finite time horizon measure life. Suppose the project life will be suppose 1 to 2 years, then the type of capital will be for that time period only. Dividend policy and the reinvestment decision. Corporate management makes a decision autonomous from the investor and the creditors. Where in the project finance, fixed dividend policy is there. Immediate payout, no reinvestment is allowed. Initially, we have to finalize each and everything. If you will talk about the capital investment decision, then corporate in corporate finance, it is opaque to the creditors, but in the project finance, highly transparent to the creditors. In financial structures, it's easily duplicated or common forms. It is highly tailored structure which cannot be generally reused. If we are doing any project financing, then it will be like a unique kind of project that uh, companies getting finance. That's why it is can't be reused. If we will see the transaction cost of financing, in a corporate finance, it is a low cost due to the completion from the competition from the providers or routinized mechanism and short turnaround time. While in the project financing, relatively higher cost due to the documentation and the longer gestation period. Size of financing is flexible. Here it is fixed. Might require critical masses to cover high transaction cost. Basis of credit evaluation will be overall financial health of the entity. Focus on the balance sheet and the cash flows of any organization because we are doing a corporate financing. Here the technical and economic feasibilities, technical and economic feasibility to focus on project asset and cash flows and contractual arrangements are there in the basic for credit evaluation. If you will see the cost of capital, it is relatively lower in the corporate finance while it is relatively higher in the project finance because there are some complications are there and lots of paper works are there. That's why project finance is more, capital cost is higher. If you will see the investors or lenders base, Then yeah, in a corporate finance, it's typically broader participation and deep secondary market. While in the project finance, typically it's a smaller group and limited to the secondary market only. So there are few financing instruments that we need to consider. These are like this table shows the matrix of financial instrument there. Here on the first column, we see the various parameters like multilateral development bank, bilateral aid, funds of foundation, green investment, means type of financial instrument, and then national development funds, commercial loans. And here these are the things like market-based loans are not available by the multinational bank. Soft loans are not available with these things, but grants are available with the multi-development bank. Equity investment can be done by the these things, but there will be no guarantees and the technical assistance. While in the bilateral aid, it's similar, but there's also no equity investment is there. Also, if you will see similarly, we can see from this table, each financing instrument can be seen from the each type of investment can be seen there. Source of this table is you can study more about this if you want. Let's move on to the next thing, that is funding sources and the stages. So there are different kind of funding sources are there that we have already studied, and like what are the funding stages? If we are funding any startup or something like well-established company, then there will be different kind of stages that we need to consider. Like some kind of technology research, technology development will be technology research will be come under the government, and the technology development will start from the venture capital. Manufacturing scale will be the private equity or public equity can start that can be combined. These are the processes and these are the fundings. And the rollout of the final assistance will be done in the public equity market, merger or acquisition. Some company will take over the companies, on the credit or debt market will be there. So these are the different stages and the different funding sources. These are the funding sources. These are the different stages. And then we can see. Now, what is green finance? Green finance is green finance can be done in a two way. One is the public fund and second is the private fund. Public fund will be associated with the like carbon market revenue, carbon related taxes or general taxes, and it will be based on the government budget and public financial intermediaries, development financial institution, national bilateral multilateral climate fund. This thing will come under this public fund. While in the private fund, there will be institutional investors, project developers, corporate actors, households. This can provide the private funds. But the commercial financial intermediaries, commercial financial institution, venture capital, private equity, and the infrastructure funds will be there in the uh, private funds. And these two things will be finally in the they can help us in the create like public funds will be used in the policy incentive, risk management, grants, or project level market debt. And here the private funds will be associated with the project level market debt, project level equity, balance sheet financing. These are the different kind of instruments that will be associated with the public and private fund. And the finally it will come for the into the distribution channel. And it will there will be two things. The one is the mitigation, like other thing will be the adaptation. Now let's move on to the debt and equity. So before that we have to know this thing, that investment is equal to the debt plus equity, or we can say D plus E. So from this we can calculate FD. FD is equal to D upon D plus E. And if we are considering debt, then the debt if we are taking any kind of debt, then we have to pay some loan. For that, there will be that some we have to know the tenure of the loan and the interest rate. So loan repayment can be calculated as the D I 1 plus I to the power n upon 1 plus I to the power n minus 1. So from this formula we can calculate the loan repayment. Now let's consider an example for better understanding for the topic. That is, consider a loan of 1 lakh rupees. What is the EMI to be paid for an interest rate of 10% for the tenure of 10 years? Here, I is equal to 10% and N is equal to 10. So we can calculate the loan repayment in that case. It will be 0.1 into 1 plus 1.1 to the power 10 and 1.1 to the power 10 minus 1. That will be equal to, if you will calculate this, you will get this 0.1627. And if we will multiply this with the 1 lakh rupees, then it will be, and we have to calculate the monthly EMI, then we have to divide from the 12 also. Calculate from the 1 lakhs, that is 1 lakh rupees. Then the final monthly EMI will be 1356 rupees per month. Now there's one another question is that how much does the EMI changes if we will change the tenure to the 5 years? Similarly, in that case, 0.1 1 plus 1 to the power 5 only, and 1.1 to the power 5 minus 1. If you will calculate this, then the months in the similar way, then the final thing that will come out to be 2198 rupees per month. So that's how the final EMI is calculated if you have taken any kind of loan. Now let's take one more example. Suppose an infrastructure company is planning to invest. An infrastructure company is planning to invest wind farm of rating 56 megawatt with capital cost of 340 rupees, 340 crores. Now the preferential tariff for wind-based electricity is 4.5 per kilowatt hour, and the annual operational and maintenance cost is 0.545. Annual operational and maintenance cost is 0.45 per kilowatt hour. That is the base electricity cost. That will be based on the annual generation. Now, assuming the life of 25 years on the capital factor of 30%, let's calculate the internal rate of return, that is IRR. If the debt is available at the 11% interest rate and the tenure for the 10 years, calculate the internal rate of return on equity for debt. Equity ratio will be 50 to 50% and 70-30%. How should the company finance the plant? Now we have two options. We should consider both of the things in that case. So let's solve this. Here CF is given 0.3, or that is 30%. Now the annual generation is 56 into 24 into 365, and that will be multiplied by 0.3. Then annual generation will be 147,168 megawatt hour. And annual revenue will be 147,168 into 4.5 minus 0.45. So here 4.5 is coming from the base electricity price, and we have to deduct the annual operation and maintenance cost from that. That is 0.45. That will be multiplied by 10 raised to power 3. Then we can calculate that annual revenue will be around 59.6 crores. If you will see on the cash flow diagram, initially we have taken a loan of something 340. Then each year we are getting 59.6, 59.6, and so on up to 25 years. Now we have to calculate what is the IRR. That is 350 crores that we have taken initially. Now for calculating the IRR, first we have to calculate the net present value. Net present value will be 0. That will be 0. For the initial year, that will be minus the. We have to assume the net present value is 0 to calculate some more things. Plus that will be 59.6 divided by 1. Here we are not having any kind of interest rate. We are assuming k is equal to 1 up to 25 years. So if you will calculate this, that will be minus 340 plus 59.6, and that will be 1 plus r to the power 25 minus 1 divided by 1 plus r to the power 25. Now if you will see that we have assumed it 0, then we can say 340. If you will transfer this thing to here, 340 will be 59.6 divided by rate of return 1 minus 1 upon 1 plus r to the power 25, and the r k plus 1th here will be 59.6 upon 340, that is 1 minus 1 upon 1 plus r k 25. And after solving this from any kind of method, it will come around 1753 on 1 minus 1 upon 1 plus rk to the power 25. Here, if you will assume that now we have the both of the equations are in on the both sides of the equation we are having rk's, and so we can assume it and do some iterations. Like if you will assume 0.1, then the rate of return will be 0.15. If you will assume it 0.159, it will be 0.1709. If you assume it 0.1709, then it will be 0.1719. And if you will assume it 0.1719, then it will be 0.17192. So we have to do the iterations till these things will we are getting the similar kind of result. So here we have calculated IRR will be 17.1%. Now for 50% debt, FT will be 0.5, E will be 170 crores, and D will be 170 crores. Now from amortization factor, we can see I is 1 plus I to the power NL divided by 1 plus I to the power NL minus 1. So here if you will put the values for 10 years here, values of NL, that is the period of NL will be the period of loan that is given at 10 years. If you will put these values at the, and the rate of interest is given 11%. That is already given in the question. We will put these values here and we will get 1 plus 1 to the power 10 minus 1, that will be 0.1698. Now from this, if you will calculate the annual loan repayment, we will see 0.169 into 170 will be 28.87 crores, and annual net revenue will be 59 minus 6, 28.87. We have to neglect it, and finally we will get around 31 crores of annual revenue. That is because we are getting a loan, so we have to deduct it from the, because this much amount we have to pay for the financing agency. Now if we will draw these things on a cash flow diagram, we will see initially we have taken a 170 crores of loan, and each year we are paying 36, so 30 upon 30. If you will take that, it will be exactly, if you will calculate this thing, that will be 30.3 crores, and we are assuming it. Let's not assume it. That will be 30.3 crores. That will be 30.3, and it is 30.3 up to 10 years. Now let's see some examples of some investor, different kind of investor types, and let's say some example and what they prefer. So from this table, if you will move upward from in this table, that will be high return and high risk. And if you will move lower in this table, that will be low return and low risk. So in the if an investor type is venture capital, then like example will be SL Partners or Social Capital. That is the kind of some the name of some venture capitalist, and the preferred asset classes, early stage companies and platforms that launching. Investment horizon, that is investment period, is 10 years, and the target return is more than 30%. Similarly, there are few other things like development, private equity, infrastructure, debt funds, hedge funds, banks, large corporation. If you will see the banks, like banks will be JP Morgan or US Bank. That is based on the US data. And preferred asset classes is currently like project finance they're doing, future like construction finance or tax equity, and investment period is more than 10 years, or some semi perms will be 5 to 10 years, and tax equity is 5 to 10 years. And they are targeting overall 7% or like 40 to 18% in some different ranges, and more than 40% for the tax equity structures. If you're seeing some large corporation, that is Apple or Chevron, that is preferred asset classes, cash and short-term commercial papers and notes, that selling the bonds, and that will be short-term, like 1 to 5 years only. And their target is 7 to 8%. And if we see the mutual fund of retail investors, that will the like Fidelity or T. Rowe Price are the companies. They will their preferred asset classes liquid securities, and they're investing for the quarterly for like 1 to 2 years or plus 10 years if you're planning for the retirement portfolio. There are some other examples you can see. You can directly go through this table for some better understanding. Now let's move to the cost of finance. If we will compare India versus US, we will see for a solar PV and an uh, onshore wind project. The solar PV US levelized cost of electricity is 100, and the India's capex lower costs to -25, and the lower output per period capacity raises, that is the cost like plus 23%, and the India's finance cost increases the cost of energy by 28%. So we will see the India is 28% more energy consuming than US. If you will see the solar PV financing. If you will plan for onshore wind production, then it will be 22 in the US. Like India's capex cost is 29% lower as compared to US, and it is providing higher outputs per unit capacity, like that we can reduce -25%. And cost, India's finance cost increases the cost of energy by 22%. Then, but initially, if we are paying $100 in the US, we have to pay only $88 in India if we are financing the onshore wind projects. This shows the return on debt and equity. this we can see. We are seeing several examples like solar PV, onshore wind, solar thermal, solar PV, onshore wind, solar thermal. Here are the debts and here are the equities. This thing shows the equity. This is shows the debt. So in India, that ranges around 10 to 15% for the solar PV, while the US range is 12 to 20%. And Europe is more than 15, but less than 20%. We are planning for the onshore, then India will be higher, and the solar thermal also India is higher. And if we see the debt, then India is providing India is in the range of 10 to 15%, while others are in the range of 5 to 10%. That is on the per year basis. So, what is the impact of debt and equity? You will see that this shows the percentage increase in India project cost above US project cost. So debt cost is 19% more. Shorter debt period, that is plus debt cost and terms in India is 32% to the cost of energy. And this thing, this all the data is for the solar PV, and this is for the onshore wind projects. We will see the overall equity cost reduces overall LCOE by 4% in India, and financing in India adds up to 28% to the LCOE. Similarly, we can see that is 22% for the onshore wind projects. So now we can compare of the we can do the comparison of the benchmarks interest rates. India is standing higher, but it is lower than the Brazil, and it is higher than the China, Indonesia, uh, Europe area, and the US. US is the lowest. This data shows that from 2005 to 2012. Now let's see the comparison of the debt rates, foreign debt versus the Indian rates. So allowed rate is up to interest rates ceiling on the foreign debt. These are the drawing taxes. This is the currency swap. This shows the 6 month LIBOR. This is the terms of project premium. And while in India there is a few things like variable rates and the corporate fixed rates. These are higher, like up to 15%. Like term swap is adding costs, and the project premium is higher, like 10%, up to 2 to 3%. In India, risk-free rates are up to 5%. So this is the summary of debt, and yellow color shows the low, green shows the medium, and pink shows the high, and red shows the very high. Cost and terms: high general Indian interest rate environment, that is for the financial market itself. So this table shows the different kinds of cost associated with the debt, and this summarizes all the things. You can go through that table and get the idea. Similarly, this table shows the equity summary. Similarly, the all the colors showing the same thing, and if you will see the different attributes like financial market, renewable specific, foreign investment, technical, tech specific, or stable specific, then we can see the cost and terms and the availability for the each kind of what is low and what is high. We can compare the different kind of cost for the equity. So this is the comparison of the renewable projects, like solar PV, solar CSP, biomass power, wind power, and the small hydro. If you will see, the capital expenses is 7 to 10 million per megawatt, and the highest in the solar CSP, and the operating cost will be highest in the also in the solar CSP tariff will also be higher. So solar CSP will be the overall higher into the each rates, but the debt to equity ratio is lower. Cost of domestic debt is also intermediate. Initial debt level are always similar in like most of the cases. Because so the major things will be the difference in the tariffs and the operating expenses. So these are the references that I've used for this lecture. Uh, you, you can use these things and understand it uh, better. So today we have learned the things like what is financing. Let me just summarize it. So here we started with the financing, that like we understood the basic term, what is the debt, what is equity. Then we have seen the risk reward profile and the methodology of the cost analysis. Then we have done the learn the financial basic, what is the risk, what is the returns, what is the causes of risk we have to consider. Then the corporate and the project financing, what is the difference between this, and we have learned the few financial instruments. Then followed by the funding sources and the stages. We have learned about the green finance, debt plus equity. Then we have calculated like how can we calculate the amount of EMI for the each year we have to pay, and here we have calculated the internal rate of return for the different situation. So these are the things that is associated with the project financing. For the more things, if you want to see, and you can refer that paper also, that is giving a one of the best paper available that I've incorporated in this lecture. So thank you. Then I will move on to the next lecture.